Usually when we talk about some kind of highly technical, high-stakes skill, there's this expectation of, mechanical precision.
Oh, absolutely.
Think about structural engineering. If you want to build a suspension bridge, you have to calculate the load-bearing capacity of the steel cables, right?
Right, it's all math.
Yeah, you measure the tensile strength, you factor in wind resistance, and the physics it simply works. It's binary.
The bridge holds the weight or it collapses.
Exactly. It's a world governed by absolute calculable certainty. And honestly, we take immense comfort in that. We want a formula where input A guarantees output B.
But see, that expectation of certainty is exactly what destroys people when they transition into the financial markets.
Yeah, it really is.
You step into active trading, whether we're talking about foreign exchange, equities, or, cryptocurrencies, and suddenly that clean mathematical formula just totally shatters.
Because it's not physics anymore.
No, not at all. You are no longer in a realm of absolute physics. You're operating in this environment of infinite variables driven by the collective and often totally irrational psychology of millions of human beings.
Right.
It's an environment of probabilities, not certainties.
And that inability to process that shift from certainty to probability is like the ultimate widowmaker.
Oh, without a doubt.
I mean, we're looking at data compiled by major brokerages for this deep dive today, specifically from Dukascopy, and the numbers are just absolutely staggering.
They're brutal to look at, honestly.
Right. 70 to 80% of retail traders consistently lose money.
Yeah.
They just blow up their accounts, they quit. We're talking about an industry with an 80% failure rate.
And that's despite having unprecedented, historical access to free information.
Exactly. Free charting software, institutional-grade execution speeds on your phone.
Right. The barrier to entry has literally never been lower.
Yeah.
But the failure rate just remains incredibly high.
Which forces this critical realization, I think.
What's that?
Well, the dividing line between the 20% who actually pull consistent profits from the market and the 80% who just act as, liquidity for everyone else, it's not a technological advantage.
No, it's really not.
It's not some magical new stochastic indicator or having a faster algorithm or a secret inside line on what the Federal Reserve is going to do next.
The secret is just trading discipline.
That's the entire ballgame.
It really is.
And to figure out exactly how that 20% actually operate, we've pulled apart an enormous stack of sources for today's deep dive.
We really went through a lot of material for this one.
Yeah, we're synthesizing quantitative data and internal analyses from top brokerages, Eurotrader, Dukascopy, Think Markets.
And we're colliding all that data with behavioral psychology.
Right, from seasoned trading professionals. We pulled from masterclasses over at Pepperstone and some really in-depth interviews from Desire to Trade.
Because the mission here is to build a comprehensive blueprint. We're talking risk management, neurological habit formation, and just the raw psychology of survival in the markets.
Because navigating these highly leveraged markets without an ironclad framework of discipline is, it's genuinely like putting a novice driver in a Formula One car.
That's a great analogy, actually.
Well, you point them down a track and you just remove the brakes.
Yeah, they have this brilliant aerodynamic chassis, 1,000 horsepower engine.
Pristine track conditions.
Perfect weather. And for a few fleeting moments, they're going to go incredibly fast. They might even feel like they're totally winning the race.
Until they hit a corner.
Exactly. The sheer velocity of the machine, combined with that inability to control the momentum, means a catastrophic crash isn't just a possibility. It's a mathematical guarantee.
Right. And the brakes don't exist to punish the driver.
Or to slow them down unnecessarily.
Well, but the brakes exist so the driver can actually navigate the corners and cross the finish line.
And in trading, the market provides the engine. It provides all that volatility and speed.
But your discipline provides the brakes and the steering wheel and the suspension.
Exactly. And whether you're trading traditional fiat currency pairs or commodities like gold, which we know can be incredibly violent, or indices, or just the absolute wild west of crypto assets like Bitcoin.
Oh, man, especially Bitcoin.
Right. The framework remains identical. We have to unpack how to stop getting in our own way.
How to stop hemorrhaging profits back to the market the literal moment after a win.
And critically, how to structurally rewire the brain for consistency.
Which, honestly, requires a fundamental redefinition of what a trader actually does.
Yeah, because the vast majority of that 80% who fail, they operate under this profound delusion.
What do you mean by delusion?
Well, they completely conflate the act of trading with the act of technical analysis.
Oh, Right.
They believe their job description is to just stare at historical price data, draw some lines on a chart, and perfectly predict the future.
They view themselves as like market prophets.
Exactly.
And that brings us to one of the most paradigm-shifting insights in our source material. This comes from Dr. Andrew Menaker.
Oh, he's a fantastic trading psychologist.
Yeah. Heavily referenced in the Desire to Trade interviews, and he completely strips the mysticism away from the charts.
He really does.
He states that technical analysis is really nothing more than looking at a visual representation of data. You use variables like time, volume, and price action, and you just come up with ideas.
Just an exercise in brainstorming.
Exactly. It's not a crystal ball. It's just a hypothesis about what the crowd might do next based on what the crowd has done in the past.
And Dr. Menaker's definition of actual trading, however, is purely risk management.
Right.
It's the conscious, calculated decision of how much capital you are actually willing to spend to find out if your brainstormed idea has any merit.
You're just paying for information.
Precisely. You are paying the market to find out if your hypothesis is correct.
And when you frame it like that, it completely neutralizes that intense psychological pressure of needing to be right.
Because if your entire identity is wrapped up in being this elite technical analyst who can predict the future.
You're attaching your ego to every single candlestick.
Exactly. If the market goes up like you predicted, you feel like a sovereign genius. Your self-worth just inflates.
But if the market aggressively turns against you?
You feel like an imposter.
Yeah.
A failure. Your emotional state is violently tethered to the random fluctuations of global liquidity.
And operating in a state of constant emotional volatility like that is just biologically exhausting.
The central nervous system cannot sustain that level of cortisol and adrenaline day after day. It just can't.
But if you adopt the professional framework that your job is just purely risk management, the emotional detachment is kind of instantaneous.
Right. You look at a chart and say, okay, I see a specific consolidation pattern that historically breaks out to the upside maybe 60% of the time.
And I am willing to spend exactly $100 to see if this particular instance falls into that 60%.
Exactly. And if the trade fails, you didn't fail as a human being.
No, you executed your job flawlessly by capping the cost of that information at $100.
Which is the absolute bedrock of the non-negotiable mathematical rule echoed universally across Eurotrader, Dukascopy, and Think markets.
Protect your capital at all costs.
At all costs. The industry standard, the absolute floor of professional risk management, is to never risk more than 1 to 2% of your total account equity on any single position.
Right. So if you have a $10,000 trading account, your maximum acceptable loss on a trade is $100 to $200, period.
Period. And I know it sounds remarkably conservative.
It's almost boring.
Bordering on tedious, especially to a retail trader who enters the market hoping to double their account balance by Friday.
But good trading is, by design, incredibly boring.
It should be. The Dukascopy analysis highlights that professionals possess an almost obsessive, paranoid focus on capital preservation over profit generation.
Because by strictly adhering to that 1 to 2% rule, you mathematically insulate yourself from the inevitable string of losses.
Exactly.
Yeah.
If you hit a streak of 5 consecutive losing trades, which, by the way, is a statistical certainty over a long enough timeline.
Right, it's going to happen.
Yeah, you've only drawn down your account by 5 to 10%. You're still fully capitalized. You're completely capable of trading the next setup.
But if you're risking 10 or 20% per trade,
that same exact string of normal variance completely wipes you out. You literally lose your seat at the table.
It's all about buying staying power. But the math of survival also requires an asymmetric reward structure, doesn't it?
Oh, absolutely.
Because it's not just about strictly capping the downside, it's about ensuring the upside actually justifies the risk.
Right. The discipline of the professionals demands a strict risk-to-reward ratio.
And the standard benchmark is a minimum of 1 to 2.
Correct. So if you're risking that $100, the technical structure of the market, like the next logical area of supply or resistance, it has to offer a highly probable opportunity to make at least $200.
And this is where the math really starts doing the heavy lifting for your psychology.
It's a huge relief when you understand this, because if you maintain that strict 1 to 2 ratio, you can literally be wrong on 50% of your trades and still generate a consistent compounding profit.
You don't need to be a market wizard.
No.
You don't need a 90% win rate. You just need the discipline to execute the math.
Just execute the math.
But, okay, let's pause here and look at the actual reality of human behavior.
Let's do it.
Because if the blueprint is really this simple, risk 1%, aim for 2%, repeat, why is there an 80% casualty rate?
It's a great question.
If a 10-year-old can understand the math of a 1-to-2 ratio, why do incredibly intelligent, successful adults like doctors, engineers, lawyers sit down at a trading terminal and completely incinerate their savings?
Because human beings are biologically and evolutionarily incapable of processing probability in real time while under stress.
Wow.
Yeah.
Incapable.
We are wired to seek absolute certainty, and we treat every single outcome as a life or death absolute.
And this brings us to the cornerstone of the work by the late Mark Douglas.
A true pioneer in trading psychology.
Yeah, he's highlighted extensively in the Desire to Trade source material. And Douglas recognized that the retail trader approaches the market like a gambler hoping for a lucky strike.
Whereas the professional trader approaches the market like the casino itself.
That casino analogy is just the perfect lens for this.
It really is. Think about the mathematics of a blackjack table.
Okay.
The casino, holds a slight, mathematically proven edge. Depending on the specific rules, the house edge might only be 1 or 2% over the player.
Right.
But the casino knows with absolute mathematical certainty that out of 10,000 hands dealt, they will win slightly more hands than they lose.
And because their edge is validated over that massive sample size, the behavior of the casino operators is totally detached from the micro events.
Exactly. The floor manager does not stand behind a specific blackjack table, sweating profusely, biting their nails, and panicking over the outcome of one single hand.
They don't care if a tourist hits a lucky streak and wins $5,000 in 10 minutes.
Not at all. They know the short-term variance is meaningless. In the short term, the outcome of any single hand is entirely random.
But in the long term, over 1 million hands, the mathematical edge of the house is an unstoppable force.
And Mark Douglas's absolute genius was applying this exact framework to retail trading.
He taught that every single trade is merely one hand of blackjack.
Yes. The outcome of your next trade means absolutely nothing.
Nothing at all.
It's just a random distribution of buying and selling pressure at that exact moment in time. Outcomes only gain significance over a series of 20, 50, or 100 trades.
So when an undisciplined trader enters a position, watches the price tick down, panics, and moves their stop loss to avoid the pain of losing.
Or gets angry and doubles their position size.
Right. They are acting like a desperate gambler who just bet their entire mortgage on a single spin of the roulette wheel.
Exactly. They need that specific trade to be a winner.
But the professional has internalized the mindset of the casino.
They understand that once they execute their pre-trade analysis, correctly size their position at 1%, and hit the buy button, their job is literally done.
They relinquish all control to the inherent randomness of the market.
Yep.
But the intellectual acceptance of probability is one thing. Actually sitting at a screen, watching your hard-earned money fluctuate in real time, that triggers an entirely different neurological system.
Oh, it's completely visceral.
If we know the math of the casino, the root cause of our failure has to be purely biological.
It is. And the Pepperstone webinar delves deeply into this, utilizing a framework developed by Professor Steve Peters in his book, The Chimp Paradox.
Okay, so we have to talk about the chimp brain.
We do, because this is where we bridge the gap between financial theory and evolutionary neuroscience. See, the human brain isn't a single, unified decision-making engine. Broadly speaking, the part of the brain that created your meticulous trading plan.
The part that calculated the 1% risk.
Right, the part that understands Mark Douglas's probability theories. That is your prefrontal cortex. It's the logical, rational, forward-thinking CEO of your mind.
But deep beneath that, you have the limbic system,
which Peters refers to as the inner chimp.
The limbic system is that primitive emotional core. It's the part of the brain that kept our hunter-gatherer ancestors alive on the savannah.
Exactly. It's responsible for the fight-or-flight response, fear, aggression, and the pursuit of immediate gratification.
And the critical flaw in human neurobiology as it relates to trading is that the limbic system processes information significantly faster than the prefrontal cortex.
So much faster. When a trader experiences a highly emotive state, say, the sharp sting of fear as a trade moves against them.
Or the intense frustration of suffering 3 consecutive losses.
Or the overwhelming panic of FOMO, the fear of missing out, as this massive green candle erupts on the chart.
Right. What happens biologically?
The amygdala basically triggers an alarm. Blood flow and electrical activity are literally diverted away from the prefrontal cortex.
Wow.
The logical brain is functionally hijacked. The chimp takes the wheel.
So in that moment of emotional hijacking, all of the traders' screen time, all the technical analysis books they've read,
All those thousands of hours spent back-testing their strategy.
it all becomes completely inaccessible.
Completely. The filing cabinets of the logical brain are locked shut. The trader is suddenly operating purely on primitive survival instincts.
Because the chimp brain does not care about a 2-to-1 risk-to-reward ratio.
It doesn't even comprehend a long-term statistical edge,
It operates entirely in the present moment.
seeking one of two things: the immediate acquisition of a perceived reward or the immediate cessation of perceived pain.
So if the chimp sees the market rallying aggressively, the pain of being left behind is just intolerable.
It demands action. It physically forces the trader's hand to click buy at the absolute top of the move,
Completely abandoning the trading plan.
just to relieve the psychological agony of missing out.
That's a terrifying realization. You aren't battling the market. You're battling millions of years of evolutionary hardwiring designed to keep you safe from predators.
And now it's actively bankrupting your brokerage account.
Right. And another psychologist from our sources, Dr. Randy Howell, he adds this deeply personal, almost psychoanalytic layer to this biological reality.
He explores the concept of scarcity thinking, right?
Yes, exactly. Dr. Howell argues that the chimp brain's panic is often fueled by deep-seated, subconscious beliefs about money and security.
Because many traders inherit a scarcity mindset from their environment or their upbringing or even generational financial trauma.
It's this foundational fear that resources are incredibly limited, and whatever you've managed to acquire can and will be violently taken away from you at any moment.
So you aren't just analyzing a candlestick chart anymore. You're projecting your deepest anxieties about survival onto the market data.
And Dr. Howell points out that this scarcity mindset actually paralyzes traders in two very specific, observable ways on the charts.
The first one is the inability to pull the trigger.
Right. A trader sees their setup forming perfectly. The pattern is there.
But the scarcity mindset, which is absolutely terrified of losing even a fraction of capital, demands absolute certainty before acting.
So they wait for another moving average to cross.
They wait for a secondary momentum indicator to confirm.
They wait for the hourly candle to close.
They wait for an external news catalyst.
They're seeking an illusion of safety that just doesn't exist in a probabilistic environment.
Exactly. And by the time they've accumulated enough lagging confirmation to feel psychologically secure, the actual entry point is long gone.
The institutional money has already made its move.
So the trader then either misses the opportunity entirely, which just confirms their belief that making money is impossible, or worse, they chase the trade late.
Right, entering at a terrible price point with massive risk exposure.
But the second manifestation of scarcity thinking is arguably even more destructive.
And this happens when the trader actually manages to enter a good position. Right.
Yes, the trade triggers. The market moves in their favor. The position is green. They have a small, unrealized profit.
And instantly, the scarcity mindset screams, you have something of value, the market is a predator, it's going to reverse and take it back.
The psychological tension just becomes unbearable. The trading plan might dictate holding the position for a $200 gain based on the next major resistance level.
But the chimp brain demands the immediate relief of securing a $20 profit right now.
So the trader manually closes the position prematurely, basically suffocating the trade out of pure fear.
They experience that fleeting rush of dopamine, the relief of safety, but they've mathematically destroyed their long-term edge by capping their winners.
While inevitably letting their losers hit their full stop-loss limits.
It's the equivalent of holding a winning lottery ticket that you mathematically know is worth $10,000, but you're so paralyzed by the irrational fear that a gust of wind might blow it out of your hand before you reach the redemption center.
that you panic and just sell it to the person standing next to you for $50.
Exactly. You've traded your mathematical advantage for a cheap hit of emotional relief.
To truly understand the insidious nature of this psychology, we really have to look at how it manifests practically on the screens. Theory is useless without application.
So let's do an audio breakdown of some specific chart scenarios mentioned in our sources. The battlegrounds where the logical plan goes to war with the chimp brain.
Let's do it.
Okay, scenario 1, the delusion of the 1,000-point move. We're looking at an index here, specifically the US 30, the Dow Jones Industrial Average.
Retail day traders are magnetically drawn to the US 30. It offers massive intraday volatility and the illusion of rapid wealth generation.
And the think markets analysis sets this scene perfectly. Imagine a trader operating on a very short time frame, maybe the 1 minute or 5 minute chart.
Okay.
They've just executed a brilliant disciplined trade in the morning session. They captured a substantial move, booked a solid profit.
Physiologically, their brain is just flooded with dopamine and adrenaline. They feel totally invincible.
The chimp brain is beating its chest high on the thrill of the hunt.
Right. And because they're riding that biochemical high, they absolutely refuse to shut down the terminal and walk away.
They want another hit.
Exactly. They begin scanning the chart again. But the market has shifted. The morning volatility has dried up, and the price action has entered this choppy, directionless consolidation phase.
The market is resting.
But the trader, blinded by the desire for more profit, begins to hallucinate setups. They convince themselves that another explosive, massive trade is imminent.
They want to capture a legendary 1,000-point move today.
And this is where the objective data must intervene to crush the subjective delusion. Think Markets introduces a critical reality check here, the ATR indicator.
Which stands for average true range.
Right. And it's important to note, it is not a predictive tool. It's a purely mathematical measurement of historical volatility.
It calculates, on average, the total distance an asset travels from its absolute high to its absolute low over a specific time frame, usually a daily session.
So the trader opens the daily properties of the US 30, applies the ATR indicator, and let's say the current reading is 5 and 12.
That number is a hard mathematical anchor. It means that given current macroeconomic conditions and liquidity, the total energetic capacity of the US 30 on a typical day is a movement of roughly 512 points.
So if the market opened at a certain level, dropped 200 points, and then rallied 300 points, it has already consumed the vast majority of its daily average true range.
The institutional volume has essentially completed its daily objective.
Exactly. So if a retail trader is sitting at their desk at 2 in the afternoon, aggressively buying the top of a consolidation pattern, expecting the market to miraculously generate another 500 points of unidirectional movement.
They are asking the market to defy physics.
They are completely delusional. They're projecting their internal greed onto an exhausted market.
It's like driving a civilian sedan with a top speed of 120 miles per hour, putting the pedal to the floor and screaming in frustration because the car refuses to hit 250 miles per hour.
Just because you really want to get to your destination sooner, the machine physically lacks the capacity.
But the disciplined trader respects the ATR. They recognize the day's range is exhausted, they accept their morning profit, and they just turn off the screen.
While the impulsive trader forces a low probability entry, gets chopped to pieces in the consolidation, and gives all their morning profits back to the broker.
It happens every day. Now let's look at scenario 2, which the Pepperstone Masterclass brilliantly deconstructs. The VWAP ignition versus the chase.
Oh, this is a classic. This revolves around a tool called the Volume Weighted Average Price, or VWAP.
And unlike a standard moving average that only calculates closing prices, VWAP incorporates both price and trading volume.
Right. It acts as a gravitational baseline for intraday institutional value. Institutions care deeply about VWAP because they use it to judge whether they are buying an asset at a premium or a discount relative to the day's average volume.
It acts like a rubber band. Price can stretch away from VWAP during bursts of momentum, but it almost always snaps back to that baseline to find equilibrium.
So the disciplined strategy surrounding VWAP requires immense patience. The trader watches the price stretch far above the VWAP line during a morning rally.
They don't chase it.
No, they wait for the inevitable exhaustion. They wait for the price to pull back, returning to the VWAP, which often acts as dynamic support.
And then they wait for a specific ignition trigger. Maybe a bullish engulfing candle or a sudden spike in volume, confirming that buyers are defending that level.
And only then do they execute, placing a tight, calculated stop loss just below the VWAP line.
Methodical, like a sniper waiting for the target to walk into the crosshairs. But let's look at the undisciplined counterpart, the FOMO chase.
The chimp brain takes control.
The trader is staring at a 1-minute chart. Suddenly, a massive block of buy orders hits the tape. The price rips violently upward, extending rapidly away from the VWAP.
The candles are huge and green. The speed is intoxicating.
The trader feels a physical tightness in their chest. The fear of missing out reaches a boiling point.
They rationalize the impulse. They tell themselves, momentum is too strong. If I wait for a pullback, I'll miss the whole move. I just need to get in right now and scalp a few ticks.
They abandon the concept of value entirely. They click the buy button in a state of pure panic.
entering the market a massive distance away from the VWAP with absolutely no logical structural level to place a stop loss.
And because markets function on liquidity, they invariably end up buying the exact top of the momentum spike.
They are the final buyer before the algorithmic profit-taking begins.
Within seconds, the momentum stalls, heavy selling volume steps in, and the price violently snaps back down toward the VWAP.
And the trader is instantly trapped in a deep, painful drawdown.
But the Pepperstone analyst made a really profound counterintuitive point about this exact scenario.
Oh, about winning.
Yeah. He argued that the worst possible outcome for a trader who chases a FOMO spike is not losing money. The worst possible outcome is actually winning the trade.
Wait, how can winning be the worst outcome? The goal is to make money.
Because of the psychological danger of operant conditioning.
Ah, right.
If a trader abandons their plan, succumbs to the emotional hijacking of the chimp brain, executes a terrible, mathematically unjustifiable entry far away from value, and the market randomly rewards them with a profit.
They've just deeply reinforced a catastrophic habit.
Exactly. Their brain associates indiscipline with a dopamine reward. They have trained their subconscious that breaking the rules is profitable.
The market has given them a false sense of invincibility.
And because that impulsive behavior is statistically unrepeatable over the long term, that trader will eventually deploy that exact same reckless habit with a larger position size, and it will destroy their entire account.
You cannot build a sustainable career on being rewarded for bad behavior.
A winning trade that reinforces toxic psychology is literally a Trojan horse.
That is a brilliant distinction.
Let's move to the final and perhaps most excruciating mental walkthrough. Scenario 3, the stop-loss spike volatility.
The ultimate test of accepting risk.
Think Markets outlines this perfectly. A trader does the analytical work. They find a great setup, calculate their 1% risk, enter the position, and place a hard stop-loss order 30 points below their entry.
Strategically positioned beneath a major support level, a textbook execution.
But the market doesn't immediately validate their idea. The price starts drifting lower. The red numbers in the profit and loss column start blinking.
The price drops closer and closer to that 30-point stop loss.
And the psychological pain of impending failure triggers the limbic system.
The trader engages in this lethal negotiation with the market. They tell themselves, my underlying thesis is still correct. The market is just hunting for liquidity. It just needs a little more room to breathe. I cannot take a loss on a trade I know is right.
So in a moment of pure emotional weakness, they click and drag their stop loss further down the chart.
They expand their risk from 30 points to 50 points.
Then, as the price continues to bleed, they move it again to 80 points.
And here is the brutal reality of market mechanics. Sometimes a high-frequency algorithm initiates a massive, momentary block of selling just to clear out the order book.
The market spikes down 100 points in a single, violent, one-minute wick.
Pure noise.
But it triggers the trader's newly adjusted, massive stop loss, liquidating their position for an enormous loss.
And then instantaneously, the liquidity is absorbed and the market aggressively reverses, ripping upward exactly in the direction the trader originally predicted.
It's an agonizing experience that leaves traders feeling targeted and cheated by the market.
But the disciplined professional views it entirely differently. The professional understands that you cannot build a risk model that accommodates infinite volatility.
Right. If you continuously widen your stop loss to absorb random 100-point algorithmic spikes, your entire mathematical edge collapses.
You'll be taking catastrophic, account-damaging losses just to avoid being stopped out of normal, manageable trades.
So the disciplined trader sets a hard stop loss based on technical structure, and they treat it as an unmovable brick wall.
If a wick spikes down, tags their stop loss for a 1% loss, and then reverses. They do not throw their mouse against the wall.
No, they coldly accept that getting stopped out by noise is simply a friction cost of doing business in a liquid market.
And this discipline becomes a literal matter of survival when we extrapolate this behavior to highly volatile assets.
Like crypto.
Yes. If you're trading traditional fiat currency pairs like the euro-dollar, moving a stop loss is a bad habit that will slowly bleed your account. But if you apply that same indiscipline to gold, XAUSD, or to the cryptocurrency markets, particularly Bitcoin.
The consequences are terminal.
Terminal. Gold is globally notorious for engineering massive liquidity-grabbing wicks. It will drop $20 in an hour just to clear out weak hands before resuming a massive trend.
And Bitcoin is a market that never sleeps, driven by unregulated leverage and immense structural volatility.
Precisely. In the crypto markets, massive liquidation cascades are not anomalies. They are structural features. A 5 or 10% movement in minutes is commonplace. So if an impulsive trader enters a leveraged Bitcoin position and removes or moves their stop loss because they refuse to accept a small defeat,
one sudden volatility spike will completely liquidate their entire margin balance.
there is no negotiating with a crypto liquidation engine. It is merciless. The 1 to 2% risk rule and the unyielding stop loss are the only armor a trader has in those environments.
Okay, we've explored the theory, the biology, and the microscopic chart mechanics. But what happens when the market decides to truly stress test your psychology over an extended duration?
Streaks.
Yes. How do you maintain discipline when you are pushed to the absolute extremes? Let's dive into managing winning streaks, losing streaks, and the toxic urge for revenge.
Because the extremes of the probability curve are where the facade of discipline usually cracks. Let's begin with a counterintuitive hazard outlined by Dukaskopy, the immense danger of a winning streak.
I mean, it sounds absurd to call winning a hazard. Every trader's objective is to stack profitable trades.
Yes, but consistent winning subtly alters brain chemistry. When a trader hits a statistical hot streak, say they execute 7 or 8 winning trades in a row, the constant influx of dopamine creates a dangerous euphoria.
They undergo a psychological shift from confident execution to arrogant invincibility.
They begin to subconsciously believe they have cracked the code of the market. They develop a god complex.
The chimp brain puts on a crown and declares itself a genius.
Exactly. And arrogance breeds complacency. The traders start skipping the tedious, boring steps of their pre-market analysis. They stop waiting for optimal entries.
But the most catastrophic symptom of a winning streak is position sizing degradation.
Because they are absolutely certain their next trade will also be a winner, they abandon the strict 1% risk rule. They leverage up, risking 5, 10, or even 20% of their capital on a single setup to maximize the rush.
And because they are still operating in a world of random probabilities, the inevitable market variance finally hits.
The setup fails, the market moves against them.
And because their position size was obscenely inflated by arrogance, that single inevitable loss wipes out the entire accumulated profit of the 8 previous winning trades, plus a massive chunk of their original principal.
The winning streak destroys them because it tricks them into abandoning the very discipline that created this streak in the first place.
Wow. And on the opposite end of the spectrum, we have the crushing weight of the losing streak,
which breeds a different kind of poison. The revenge trade.
You execute your trading plan perfectly, you follow all your rules, but the market structure changes, and you take 3 consecutive 1% losses.
The pain is intense. The frustration of doing everything right and still losing money boils over. You feel the market owes you something.
The revenge trade is an act of pure emotional retaliation.
The trader stares at the red numbers on their daily profit and loss column, and the desire to just get back to even overpowers all logic.
They immediately force a 4th trade into a market environment that is clearly not conducive to their strategy.
There is no technical setup. There is no edge. They are just throwing capital at the screen in a desperate attempt to erase the pain of the previous losses.
And usually they double their position size on the revenge trade to ensure they make the money back faster.
Which almost universally results in a 4th, significantly larger loss, pushing the trader from a manageable drawdown into an emotional tailspin.
So how do the top 20% actually manage these extremes? How do they survive the biological urge to blow up their accounts?
The professionals survive by implementing mechanical, operational circuit breakers.
Okay.
They do not rely on willpower in the heat of the moment because they know willpower is a finite resource that the chimp brain will eventually overpower. They utilize strict drawdown thresholds.
A hard mathematical line in the sand.
Precisely. A professional might have a daily drawdown limit of 3%. If they take 3 consecutive 1% losses, they hit that threshold.
And when that number is breached, it triggers an automatic, predetermined, non-negotiable protocol.
A complete trading hiatus.
They literally close the charting software. They shut down the brokerage platform.
They remove themselves from the environment. They go to the gym, they go for a walk, they read a book. They recognize that after 3 losses, their emotional state is compromised.
Their lens is fractured.
They do not allow a hijacked brain to make capital allocation decisions.
The concept of the circuit breaker makes logical sense, but I have to push back on the reality of implementing it.
Okay, go ahead.
When you are sitting in that chair, in the middle of a brutal losing streak, your heart rate is elevated, your face is flushed, the adrenaline is pumping, and your finger is hovering over the mouse.
The urge to click buy and execute a revenge trade is physically overwhelming.
Exactly. How do you biologically interrupt that impulse in the exact second it's happening?
The Think Markets analysis provided a remarkably simple yet profoundly effective neurological hack for that exact microsecond.
It's a technique rooted in cognitive behavioral therapy called name the feeling.
How does naming it stop the physical action of clicking the mouse? Because of how the brain processes language versus emotion. When the chimp brain is raging, it is operating entirely in the subconscious emotional centers.
The urge to revenge trade feels like an uncontrollable physical compulsion.
But the moment you force yourself to articulate that feeling out loud, you are forcing electrical activity back into the prefrontal cortex, the logical language processing center of the brain.
So you sit at the desk and you literally talk to yourself.
You verbalize the internal state. You say out loud, I'm looking at the screen. I feel a massive urge to enter the market right now to win my money back. I am feeling intense anger and deep discomfort. I acknowledge this urge, but I am not going to act on it because historically, acting on this specific feeling only leads to larger losses.
Wow, you are dragging the subconscious impulse into the conscious light. You are labeling the chimp, validating its anger, and then structurally denying its request.
Labeling the emotion strips it of its subconscious power. You accept the acute temporary pain of sitting in a drawdown rather than seeking the toxic relief of a revenge trade.
And once you've named it and broken the spell, you possess the momentary clarity required to stand up, push the chair back, and walk away from the terminal.
It's incredibly powerful.
That is an incredibly powerful tool, and it serves as the perfect bridge into the next phase of our deep dive, because everything we've discussed, accepting probabilities, recognizing the chimp, implementing circuit breakers, requires the construction of entirely new neural pathways.
We have to unpack the practical blueprint for building the discipline muscle. It is not a genetic trait you are either born with or lack. It's an operational framework.
That is the most liberating realization for a struggling trader. Discipline is simply a series of repeatable actions.
The Pepperstone Masterclass dedicated significant time to detailing exactly how professionals engineer this behavior. Tactic number 1 is environment design, or the philosophy of making the right choice the easiest choice.
The Pepperstone presenter used a phenomenal analogy for this. If you are deeply committed to losing weight and improving your physical health, you do not test your discipline by sitting inside a bakery for 8 hours a day,
staring at rows of fresh chocolate cake and relying purely on your internal willpower to resist eating them. Your willpower will eventually fatigue and you will eat the cake.
The intelligent approach is to entirely remove the cake from your physical environment. You don't bring junk food into your house.
You structure your environment so that failing requires active, difficult effort. This applies directly to the trading desk.
So if your historical data shows that your biggest weakness is severe overtrading and chop-out losses during the lunchtime hours.
When institutional volume dries up
Yeah.
and the market just aggressively fluctuates in a tight, unpredictable range.
You don't sit in front of the charts at noon, white-knuckling the mouse and praying you have the discipline not to click.
You stop playing the game on maximum difficulty. You physically close the laptop. You step out of the office.
If you are waiting for the price to reach a specific high probability level, you set an automated price alert on your mobile phone and walk away.
You only return to the screens when the market actually meets your criteria. You engineer an environment where overtrading becomes logistically difficult.
Tactic number 2 in the blueprint elevates the concept of record keeping far beyond basic accounting. We have to discuss the true function of a trading journal.
The Dukascopy source is adamant that a simple ledger of wins and losses is insufficient for behavioral change.
A basic spreadsheet just tells you what happened. A professional journal tells you why it happened.
You are logging the environmental context. You note the exact time of day. You record the ATR reading. Was volatility expanding or contracting?
Was there a major macroeconomic news release like a CPI print or a non-farm payroll report that distorted the technical structure?
And most critically, you meticulously document the internal environment. Jared Tindler, a renowned peak performance coach whose work is heavily featured in the Desire to Trade interviews, introduced the concept of the mental hand history.
It's a term borrowed from elite poker players who review the strategic mechanics of the hands they played.
Tindler applies it to reviewing the psychological mechanics of your thoughts.
It's the process of getting the emotional noise out of your head and onto a physical page.
Precisely. In your journal, next to the screenshot of the chart and the financial result, you write down exactly what your internal dialogue was before, during, and after the trade.
You document. I saw a massive bullish momentum candle. I felt a surge of FOMO. My heart rate elevated. I abandoned my requirement for a pullback to the VWAP and bought the absolute top. I felt immediate panic when it reversed.
By forcing yourself to articulate the physiological and emotional triggers, you begin to demystify your own sabotage.
You transform a vague sense of failure into hard, undeniable data. When you review your journal at the end of the month and physically see that 80% of your losses were preceded by the exact same feeling of FOMO, the illusion that you are a victim of random market bad luck shatters.
You confront the reality that your unmanaged emotions are your single greatest overhead cost.
Which brings us to tactic number 3. A method for actively rewiring those emotional responses before they happen. State change visualization.
Visualization is a standard tool in high-performance athletics, but the application in trading requires a very specific, almost brutal methodology. You are not sitting cross-legged on a pillow manifesting millions of dollars falling from the sky.
You are mentally rehearsing the absolute worst moments of temptation. You close your eyes and you construct a vivid, high-definition mental simulation of the exact chart pattern that usually triggers your catastrophic habits.
Yes, you visualize the 1-minute chart violently accelerating. You vividly picture the green candle expanding. You force yourself to actually feel the familiar physical tightening in your chest.
You summon the emotional pressure of the FOMO. You let the chimp brain scream.
And then, within the mental simulation, you rehearse the exact physical mechanism of restraint. You visualize yourself taking a deep breath, physically pushing your chair away from the desk, letting go of mouse, and verbally stating, "This is not my setup. I am preserving my capital."
You are cutting a new neurological groove in the brain, practicing the act of surrender over and over again. But the Pepperstone expert added a critical biological layer to this practice that completely fascinated me.
Oh, about state-dependent learning.
Yes. He insisted that this visualization should not be done while you are perfectly relaxed. It must be done when your physical state is actively, intensely altered.
He is leveraging the neuroscience of state-dependent learning. If you practice a calm visualization while lying in a comfortable bed, those neural pathways remain relatively weak and disconnected from the reality of the trading desk.
Because when you are actually trading and the market is moving against you, your body is flooded with cortisol and adrenaline. You are in a heightened physiological state of stress.
So to make the visualization actually stick, you have to practice it while simulating that biological stress. The expert suggested running this mental rehearsal immediately after an exhausting, high-intensity gym session.
Or while sitting in a sweltering sauna.
Or, incredibly, while submerged in an ice-cold plunge pool.
It sounds extreme, but the biological mechanics are undeniable. When you step into a cold plunge, the shock of the freezing water triggers a massive release of norepinephrine.
Your heart rate spikes. Your body genuinely believes it is in a survival situation. It is the exact same physiological cocktail of stress that you experience during a massive trading drawdown.
If you can sit in that freezing water, command your breathing, control the panic, and vividly visualize yourself executing perfect trading discipline, you are forging incredibly dense, durable neural pathways.
You are training the brain to access logical restraint while under severe biological duress. When you eventually return to the trading desk and the adrenaline hits, the brain already knows exactly how to navigate the storm.
It is the ultimate form of psychological armor. Now, the final tactic in this operational blueprint is slightly more cognitive, but equally powerful. It is the construction of a mental board of directors.
This is a fantastic psychological buffering technique. You consciously build an imaginary advisory board comprised of the elite mentors and professionals whose philosophies we've been discussing.
You populate the board with Mark Douglas, Dr. Brett Steenbarger, Dr. Randy Howell, or perhaps a highly disciplined trader you personally admire.
The objective is to externalize the decision-making process when your internal compass is spinning. You are sitting at the screens. A trade is bleeding into the red. Your chimp brain is violently demanding that you widen your stop loss just a little bit more to avoid the pain.
In that critical fraction of a second, you pause and you mentally consult the board. You ask, what would Mark Douglas explicitly instruct me to do in this exact moment?
And because you have studied his work, the answer is immediate and undeniable. You know, Douglas would look at the chart and say, the outcome of this single trade is entirely irrelevant to your long-term success. It is just one distribution of probability in a massive sequence. Honor the stop loss, accept the small paper cut, and preserve your capital to play the edge tomorrow.
By routing the decision through the imagined perspective of an elite professional, you create a momentary cognitive gap. You decouple your ego from the immediate outcome.
It is infinitely easier to follow the cold logic of Mark Douglas than it is to wrestle your own panicked inner chimp into submission.
It's a profound structural hack for discipline. However, the Pepperstone presentation makes a crucial point about the journey of building this blueprint. The process of behavioral rewiring is rarely linear.
It is messy. There will be relapses. The chimp will occasionally win a battle. A critical component of long-term success is deploying radical self-compassion when you inevitably break a rule.
This is such a vital distinction because the perfectionist mindset is actually a trap. A trader might go 3 weeks executing their plan flawlessly. Then, on a random Tuesday, they get tired, they get emotional, they chase a FOMO spike, and they take an unnecessary loss.
The immediate reaction is intense self-hatred. They beat themselves up relentlessly. They tell themselves they're a failure and that they will never figure this out.
And that self-flagellation is incredibly destructive because it triggers the what the hell effect. It is the exact psychological mechanism of a restrictive diet.
Someone eats nothing but clean, healthy food for a month. One night, they slip up and eat a single chocolate chip cookie. The perfectionist mindset dictates that because the diet was slightly breached, the entire endeavor is ruined.
So they say, what the hell, the streak is over. And they proceed to consume the entire box of cookies and a gallon of ice cream.
In trading, that translates to taking one small, undisciplined loss, deciding the day is ruined anyway, and proceeding to revenge trade until the entire account is liquidated.
You have to treat the broken rule as a data point, not a moral failing. You write down the error in the mental hand history, you acknowledge the lapse, you forgive the chimp, and you violently commit to executing the very next trade perfectly.
You track your progress using a daily scorecard, aiming for a 90% compliance rate with your routine rather than demanding an impossible standard of absolute perfection. Incremental consistency is the goal.
Which brings us to the ultimate foundational truth of this entire deep dive. This is Section 6, the secret weapon. This is the realization that the true battle for trading mastery is not actually fought on the charts.
The profound transformation happens when the trading terminal is completely shut down.
You cannot isolate your behavior. You cannot be an undisciplined, chaotic person in your daily life and then magically transform into a monk-like paragon of risk management the second you sit down in front of a candlestick chart.
The Pepperstone Masterclass hammers this point with absolute authority. How you do anything is how you do everything. If your personal life is devoid of structure, that chaos will inevitably violently bleed into your trading performance.
You cannot outsmart your own underlying identity with cheap affirmations. Standing in front of a mirror and forcefully chanting, "I am a disciplined trader," is utterly meaningless if your daily actions continuously prove the opposite.
You have to actively, painstakingly construct the identity of a disciplined person from the ground up, starting with the most mundane elements of your existence.
The compounding effect of micro-decisions. Let's look at the absolute baseline, the morning routine. Your alarm goes off at 6 in the morning. Your body is tired. It is cold outside.
The immediate impulse is to hit the snooze button. The chimp brain wants the immediate comfort of 9 more minutes of sleep.
When you hit that snooze button, you might think it is a harmless choice. But neurologically, it is a micro-betrayal. You have just broken the very first promise you made to yourself that day.
You've signaled to your subconscious that your commitments are flexible. That comfort dictates your actions. The secret weapon is building a fortress of integrity through small, uncomfortable actions.
When the alarm sounds, you stand up immediately. You make your bed with precision, creating instant order in your environment. You execute your physical workout regardless of your motivation level.
You adhere strictly to your nutritional parameters. You actively seek out and conquer discomfort, whether through rigorous exercise or those freezing cold plunges we discussed.
You are systematically training your brain that your internal standard overrides your temporary emotional state. If your default setting in life, your absolute baseline, is to always seek the path of least resistance, to continuously negotiate with your own laziness, then the outcome at the trading desk is predetermined.
The moment a trade moves against you, the moment you feel the acute psychological discomfort of an impending financial loss, your brain will automatically execute its default programming. Seek immediate relief, avoid the pain, and break the rule to find comfort.
And this culminates in the most powerful psychological concept we will discuss today, the imperative to let your word have meaning.
The alignment of language and action.
Exactly. Consider the casual throwaway statements we make constantly. A trader might look at the market on a Friday afternoon, notice the volume is low, and say out loud to themselves, "The market looks terrible. I am absolutely not going to take a trade today."
An hour later, out of sheer boredom and a desire for stimulation, they open the mobile app, rationalize a subpar setup, and execute a trade.
I am incredibly guilty of this in everyday life. I will definitively state I am not drinking coffee past 2 p.m. today, and by 3 p.m. I am standing at the espresso machine making excuses. We brush it off as a minor lack of willpower.
But it is not minor. It is structural self-sabotage. Every time you casually discard a commitment, you are actively conditioning your subconscious mind that your spoken words carry absolutely no weight.
You are creating a deep neurological schism between your intentions and your actions. You are teaching your brain that you are fundamentally unreliable.
So when the stakes are incredibly high, when you are sitting at the trading terminal with a massive position open, the market is wildly volatile, and you confidently declare to yourself, "I am going to maintain my discipline. I am not going to move this stop loss under any circumstances."
Your brain simply does not believe you. The subconscious mind accesses your historical data, looks at your track record of endless broken promises, and concludes that your declaration of discipline is completely hollow.
It knows you are bluffing. It knows that when the pressure increases, you will inevitably fold, because that is your established pattern. And the chimp brain immediately overrides your logic and moves the stop loss.
The integrity of the self is the ultimate trading edge. The secret weapon is aligning your daily actions with your words so completely that your subconscious stops fighting you.
If you tell yourself you are going to go for a run, you run. If you tell yourself you are not opening the charts today, the computer remains off. By relentlessly honoring your micro-commitments in the mundane aspects of life, you forge an unbreakable internal trust.
When you reach that state of profound alignment, a massive psychological shift occurs. Following your trading plan ceases to be an exhausting, white-knuckle battle of willpower against the chimp brain.
Risk management is no longer a set of oppressive rules you have to force yourself to obey. Discipline simply becomes the effortless expression of who you fundamentally are. The identity of the professional has been successfully installed.
That is a phenomenally heavy yet profoundly empowering place to begin wrapping up this massive deep dive. We have traversed an incredible amount of territory today, moving from the mathematics of probability to the evolutionary biology of the savannah, and finally to the daily construction of personal integrity.
To summarize the core architecture, consistent profitability is not derived from predicting the future. It is derived from a pathological dedication to the process. As Dr. Brett Steenbarger reminds us, the elite professionals operating at institutional levels frequently maintain win rates hovering right around 50%.
They are factually wrong half of the time they enter the market.
Yet they extract immense wealth from the markets because they have mastered their biology. They strictly enforce the 1 to 2% risk parameters. They detach their ego from the outcome of the individual trade.
They recognize the deceptive dopamine traps of winning streaks and the toxic revenge cycles of losing streaks.
They utilize circuit breakers, extensive mental journaling, and environmental design to insulate their logical plan from their emotional chimp. And above all, they cultivate an identity of unshakable consistency outside of the markets.
As we close this masterclass, I want to leave you with a final, highly provocative perspective shift. It is a thought to mull over the next time you sit down at the charts.
We expend an enormous amount of mental energy attempting to completely eradicate losing trades from our lives. We view every loss as a painful failure.
But consider this. What if the very next losing trade you take is actually the single most valuable, most critical trade of your entire year?
How could a loss be the most valuable trade?
Not because of the capital you surrender, that is merely the cost of tuition. It is valuable because a perfectly executed loss is the ultimate crucible for your newly built identity.
Imagine the scenario. You execute a trade based flawlessly on your edge. The market randomly dictates a loss. The red numbers flash. The chimp brain begins to scream for retaliation. The urge to revenge trade flares up.
But instead of breaking, you observe the emotion. You name the feeling out loud. You respect your hard stop loss. You absorb the psychological sting without flinching.
You calmly log the mental hand history in your journal. You push your chair back, and you walk away with your account capital completely protected.
A loss navigated with absolute, unshakable discipline builds exponentially more mental resilience and deep-seated confidence than 100 easy, lucky wins ever could.
It is the definitive proof to your subconscious mind that you are, in fact, the disciplined professional you claim to be.
A flawlessly executed loss is a monumental victory for your discipline. That reframing changes absolutely everything, which brings us full circle back to the starting line and the Formula One car.
The financial markets will perpetually provide the engine. They will endlessly offer the exhilarating speed, the terrifying volatility, and the illusion of rapid wealth.
But it is your rules, your risk management ratios, and your unyielding daily habits that construct the brakes. And those brakes, that disciplined restraint, are the only elements that will keep you on the track long enough to survive the variance and actually see the checkered flag.
The mechanics are proven. The biological pitfalls are mapped. The blueprint is in your hands. The execution is entirely up to you.
We want to keep this conversation going because the psychological battle is fought every single day. How do you maintain your own discipline when the market geometry breaks down and the charts become chaotic?
Do you utilize a specific pre-trade routine to center yourself?
Do you leverage physical habits like intense exercise or cold plunges to reset your nervous system before facing the screens? Share your strategies, your failures, and your breakthroughs with us.
Thank you for dedicating your time and diving incredibly deep with us today.
Protect your capital, manage your chimp, and we will see you on the next deep dive.